Something just shifted in the banking framework and barely anyone is discussing it. Not major stories, not urgent bulletins, not even a crawling newsfeed along your screen's edge. But within private chambers, the regulations that are meant to safeguard your funds were silently revised. And here's the element that should give you pause. You currently have a 90-day period linked to that choice, and most individuals don't even realize it's available. This isn't regarding some theoretical policy discussion or something hidden deep in financial terminology that only impacts large investors. This affects your transaction account, your deposits, your future funds, anything linked to a financial institution. Because at the precise moment when the financial framework is displaying indicators of strain once more, the individuals in authority didn't strengthen the regulations, they relaxed them. And they executed it without consulting you, without clarifying it, and without placing it where you genuinely notice it. The genuine question isn't simply what shifted, it's why it shifted at this moment and what that reveals about the framework beneath everything you depend on. Because when you begin examining that thread, you don't simply discover one issue. You discover levels, 4 of them positioned directly above your funds, each one altering how secure that money truly is, and once you observe all 4 combined, it becomes very difficult to view your financial account the same way afterward. Hi, I'm Ivy, and this is the US Guide, and what I'm going to accomplish in this presentation is guide you through precisely what shifted using the genuine documents, the decisions, and the figures without the distractions, without the alarm, and without presuming you have a foundation in finance. Because the reality is, most of this isn't complex. It's simply not clarified in straightforward language, and that space between what's occurring and what individuals comprehend is where uncertainty and danger tends to exist. So, we're going to eliminate that space. Step by step, I'll demonstrate how the framework was already organized before this choice, what the new regulation modification genuinely accomplishes, and why it's significant right now, not in concept but in actionable terms that link directly to your regular financial existence. And by the moment we're finished, you'll be capable of observing the complete picture clearly enough to form your own choices regarding what to pursue next. But to comprehend why this recent shift matters as much as it does, we must begin with something most individuals never consider. What's genuinely occurring to your funds the instant you place it in a financial institution. The instant you place money into a financial institution, something significant and often misinterpreted occurs. It feels like you're positioning your cash somewhere secure, like it's remaining there waiting for you whenever you require it. But in reality, that's not how the framework operates anymore. And in some ways, it hasn't operated that way for a considerable duration. Back in March of 2020, the Federal Reserve made a choice that fundamentally altered the organization of banking in the United States. They reduced the reserve obligation to 0, not decreased it, eliminated it. What that means in straightforward terms is that your financial institution is no longer legally obligated to maintain a single dollar of your deposit available. Not a proportion, not a segment, 0. So when your earnings hit your account, it doesn't simply remain there. It becomes part of a much broader pool of capital that the financial institution can transfer, loan, invest, or deploy elsewhere. And under the present regulations, there's no minimum amount they must maintain in reserve in case you or everyone else desires their money returned at the same moment. A straightforward way to visualize this is to imagine a vehicle storage facility where you leave your automobile overnight. You presume it'll be there in the morning precisely where you left it. But in this version of the facility, there's no regulation requiring them to maintain your automobile in your space or even in the structure. Instead, they're permitted to lease it out while you're asleep, send it across town, perhaps even across regional lines, and when you return for it, the only way you obtain your automobile is if enough other automobiles happen to be returned at the same moment. Most occasions, that framework operates fine. Individuals come and depart, automobiles cycle in and out, and nobody notices. But the entire organization depends on one thing, not everyone appearing at once. That's the foundation your financial account is constructed on today. And what makes this more significant is that this wasn't a temporary emergency action that got reversed. It's still in position quietly, permanently, at least for now. So that's level 1. Your money feels like it's there, but organizationally, it isn't remaining still in the way most individuals imagine. Now, level 2 constructs directly on top of that. And this is where the regulations transition from how financial institutions operate to what occurs if something goes incorrect. Because after the financial crisis in 2008, there was a massive resistance against taxpayer-funded rescues. Hundreds of billions of dollars were utilized to stabilize major financial institutions, and the public response was loud and clear: never again. So legislators stepped in and rewrote the playbook. On the surface, it sounded like a victory. No more rescues using taxpayer money. But what replaced it is something most individuals have never had clearly clarified to them. It's called a bail-in. And the distinction isn't simply technical, it's personal. In a bail-in situation, if a major financial institution encounters difficulty, it doesn't reach outward to taxpayers for support. It reaches inward into its own organization. That includes bondholders, shareholders, and critically depositors, which means individuals with money in the financial institution. Because legally, when you deposit cash, you're not storing it in a vault with your name on it. You're lending it to the financial institution. In return, they give you a claim, a balance on a screen, but not ownership of specific physical dollars. In legal terms, you become what's called an unsecured creditor. And that phrase matters because it defines your position if things begin to unravel. You're part of the framework that can be utilized to stabilize the financial institution itself. Now, this is usually where individuals say, okay, but that's why we have FDIC insurance. And that's a fair point, because up to a certain threshold, that protection has operated historically. It's been dependable, consistent, and for decades it's accomplished precisely what it was designed to accomplish. But once you begin examining closely at how that framework is organized today, especially in the context of everything else we're walking through, you begin to observe why that reassurance might not be as absolute as it sounds on the surface. And that's where the next level begins, because the genuine question isn't whether protection exists, it's whether it's constructed to handle the kind of pressure the framework is facing now. So, let's examine directly at that protection, because this is where the discussion shifts from how the framework operates to whether the mathematics behind it genuinely holds up. The FDIC, the Federal Deposit Insurance Corporation, is the backstop most individuals depend on without thinking twice. It's the reason you'll hear your money is insured up to $250,000. And historically, that statement has been accurate in practice. Since its creation in 1933, the FDIC has stepped in and covered insured depositors every single occasion it's been tested. That track record matters, but what also matters, especially right now, is the magnitude of what it's promising compared to what it genuinely has available. As of now, the FDIC holds roughly $129 billion in its insurance fund. That sounds like a massive figure, and on its own, it is. But the total amount of deposits it insures is over $10 trillion. When you break that down, it comes out to about $1.17 set aside for every $100 it guarantees. And that's not a rounding mistake. That's the organization. The framework isn't designed to cover everything at once. It's designed around the presumption that it won't have to, that failures will be isolated, manageable, and spread out over duration. And most of the duration that presumption holds. But when stress begins to construct across multiple institutions at once, that's when the space between perception and reality becomes harder to ignore. We obtained a glimpse of that in 2023 when several major regional financial institutions failed in rapid succession. In order to cover insured depositors, the FDIC had to step beyond its existing reserves and borrow approximately $93 billion. Think about what that implies for a moment. The framework that insures your deposits had to borrow money to fulfill the insurance it had already promised. Again, that doesn't mean failure is inevitable, but it does reveal how tightly balanced the framework really is. It operates until it's forced to stretch. And when it stretches, it depends on external support, coordination, and timing. So now, if you step back and examine at the first two levels together, Your money not being required to remain in reserve and the insurance framework operating on fractional backing, you begin to observe a pattern. It's not regarding one weak point, it's regarding how those points interact under pressure. And that brings us to the third level. Because even within that framework, if something does go incorrect, there's another detail that most individuals never observe coming. It's not simply whether your money is protected, it's where you stand in line to obtain it returned. Because in a financial institution resolution situation, there's a hierarchy, a legal order that determines who receives paid first, who receives paid later, and who may end up absorbing losses. And here's where things become less intuitive. The financial contracts that financial institutions utilize to manage danger, things like derivatives, are given special priority under present regulations. In straightforward terms, that means those obligations can be settled before depositors are fully made whole. Now, derivatives might sound abstract, but the magnitude is anything but. We're discussing about tens of trillions of dollars tied up in these instruments across major financial institutions. Individual financial institutions can hold exposures in the tens of trillions alone, and across the framework, the total climbs even higher. So when you imagine a line forming during a crisis, individuals expecting to access their deposits, you're not standing at the front of that line. You're standing behind a massive level of financial obligations that were never part of your day-to-day banking experience, but are deeply embedded in the framework your financial institution operates within. And if that still feels theoretical, there's a real-world example that demonstrates how this can play out. In 2013, Cyprus went through a banking crisis that forced precisely this kind of restructuring. Depositors woke up to discover that a significant portion of their funds, especially amounts above insured thresholds, had been converted into shares of failing financial institutions. Access to accounts was restricted. ATMs were drained within occasions. Financial institutions remained closed for weeks, and capital controls stayed in position for years. And more than a decade later, some depositors are still attempting to recover what they lost. That wasn't a fringe framework or an isolated experiment. That was a modern banking environment with central oversight and deposit insurance frameworks in position. So when you combine everything we've covered so far, the organization of deposits, the thresholds of insurance, and the priority order in a crisis, you begin to observe that the framework isn't constructed on a single guarantee. It's constructed on a series of presumptions regarding timing, behavior, and stability. And as long as those presumptions hold, everything appears solid. But when they're tested, that's when the underlying mechanics begin to matter in ways most individuals never expected. Now, if all of this still feels like something that exists mostly on paper, technical, distant, unlikely to genuinely surface in a genuine world situation, then what comes next is where that perception begins to shift, because some of the clearest insights into how the framework genuinely views these dangers didn't come from critics or outsiders. They came from inside the chamber. In November of 2022, the FDIC held a closed-door gathering that was later made publicly available on their own website. It brought together high-level officials, individuals with deep ties to major financial institutions, former executives from institutions like Goldman Sachs, and senior policymakers who've spent decades inside the financial framework. And during that discussion, something was stated that rarely receives clarified this directly. One participant acknowledged on record that depositors could be exposed in a crisis, that bail-ins are not simply theoretical but part of the framework. But in the same breath, the concern wasn't regarding whether the framework allowed for that. It was regarding how much the public should comprehend. Because if individuals fully grasped how these mechanisms operate, it could trigger the very thing the framework is designed to avoid, a loss of confidence. And that's the word everything hinges on, confidence. Because modern banking frameworks don't simply run on capital, they run on trust, the presumption that your money will be there when you require it, the belief that the organization underneath is stable enough not to question. And once that belief begins to crack, behavior changes. Individuals transfer funds, they ask different questions, they stop presuming, and that shift alone can create pressure. Another voice in that same discussion framed it even more clearly, pointing out that there's effectively two audiences, There's the institutional side, large participants who comprehend how the framework operates in detail, and then there's everyone else. And the implication was that those who really desire to comprehend will discover a way to comprehend, but it's not something broadly emphasized. When you translate that out of policy language, it reveals something significant. The framework depends on most individuals not digging too deeply into its inner workings, not because there's a single hidden flaw, but because the complete picture is complex, and complexity can alter behavior if it's suddenly brought into focus. And that brings us directly into what just occurred. Because against that backdrop, where confidence is already a critical variable, the individuals overseeing the framework made a choice that moves in a very specific direction. On March 19, 2026, three key regulatory bodies, the Federal Reserve, the FDIC, and the Office of the Comptroller of the Currency, voted on a set of modifications tied to what's broadly known as Basel III. The name itself isn't significant. What matters is what these regulations were originally designed to accomplish. After the 2008 financial crisis, regulators recognized that financial institutions needed stronger buffers, more capital held in reserve to absorb losses if markets turned. So, they implemented stricter obligations, especially for the largest institutions, to make sure there was a cushion between instability and depositor impact. That was the arrangement for more than a decade. More resilience, more protection, more margin for mistake. But in this latest decision, that direction shifted. The updated regulations allow large financial institutions to operate with comparatively less of that protective cushion. In other words, the very buffer that was meant to absorb shocks before they reach the public has been reduced. And this didn't occur during a period of total calm. It's occurring at a duration when multiple financial indicators are already displaying strain, when interest rates are elevated, when global markets are adjusting, when liquidity conditions are tighter than they've been in years. Now, to be clear, this isn't being framed by regulators as removing safety altogether. The argument is that the framework has evolved, that financial institutions are better positioned, that flexibility is needed. But when you position that choice alongside everything we've already walked through, the zero reserve obligation, the organization of deposit insurance, the priority hierarchy in a resolution, it becomes part of a broader pattern. Not a single modification in isolation, but a series of adjustments that all move in the same direction. Less immediate protection at the point where stress would be felt first. And here's where that 90-day period we mentioned at the very beginning comes back into focus. Because this choice isn't fully locked in yet, there's a formal comment period open right now where the public can respond before the regulations are finalized. Most individuals will never observe it. Most won't know where to examine. But it exists. And once that period closes, the framework we've just outlined doesn't simply remain theoretical. It becomes the defined organization going forward. That 90-day period isn't simply a technical step in the process. It's one of the few moments where something like this is briefly visible before it becomes permanent. Right now, there's a public comment period open on the Federal Register. Anyone can submit a response. Not simply institutions, not simply lobbyists, anyone. And by law, those comments have to be reviewed as part of the rulemaking process. Now, whether they alter the outcome is a different question entirely. But the existence of that period tells you something significant. This isn't fully set in stone yet. It's in that narrow phase where awareness genuinely matters because once that period closes, the shift we've been discussing about, the reduced cushion, the recalibrated safeguards moves from proposal to policy. And at that point, it becomes part of the baseline presumptions the framework operates on. Quietly, permanently. No announcement, no headline moment where someone clarifies it in straightforward English. It simply becomes the new normal. And historically, that's how many of the most significant financial modifications occur. Not with a single dramatic reveal, but through gradual adjustments that only become obvious when you examine back. So the question becomes, if this is occurring now in this environment, what are the individuals closest to the framework accomplishing with that same information? Because one of the most consistent signals in financial history isn't what's stated publicly. It's how capital moves privately. And when you begin examining in that direction, a pattern begins to emerge that's difficult to ignore. Over the past year, one of the most closely watched investors in the world has been making a series of moves that stand out, not because they predict the future with certainty, but because of their magnitude and timing. Over multiple quarters, hundreds of millions of shares in major banking institutions were sold off. Not all at once, not in a panic, but steadily, consistently, in magnitude. At the same duration, that capital wasn't immediately redeployed into other risk-heavy sectors. It was held, parked, accumulated into a massive cash position. Hundreds of billions of dollars sitting on the sidelines. Now, that doesn't automatically mean something is about to break. Markets are complex, and there are always multiple reasons behind large portfolio choices. But context matters because alongside those moves, internal voices within the banking world have also begun drawing comparisons that haven't been heard in a considerable duration, specifically parallels to the period leading up to the 2007-2008 financial crisis. Not identical conditions, but similar patterns in how different indicators are lining up at the same duration. Things like sustained high energy prices, a strong dollar index, pressure on equity markets, and rising long-term bond yields. On their own, each of these can be managed, but when multiple indicators begin moving together, they can create feedback loops, tightening financial conditions in ways that ripple across the framework. And according to some of the analysts closest to the banking sector, several of those signals have already been triggered, while others are getting close. So when you step back and examine at the complete picture, you begin to observe two parallel tracks. On one side, regulatory adjustments that reduce certain buffers. On the other, large-scale capital movements that suggest a more cautious positioning from those paying closest attention. And right in the middle of those two tracks is where most individuals are standing, still operating under presumptions that haven't fully caught up to what's altering underneath. When you line everything up, not individually, but all at once, the picture becomes a lot clearer. You have a framework where financial institutions are no longer obligated to hold reserves against your deposits. On top of that, the insurance designed to protect those deposits operates on a fraction of the total it guarantees. Then, in a worst-case situation, there's a legal organization that determines who receives paid first, and depositors aren't necessarily at the front of that line. And now, layered over all of it, the very safeguards that were strengthened after the last major crisis are being adjusted in a way that reduces the buffer between instability and impact. None of these pieces on their own automatically lead to a crisis. That's significant to state clearly. But frameworks aren't tested one piece at a duration. They're tested all at once under pressure in genuine world conditions that don't follow a script. And at the same duration, you're observing signals subtle but consistent from within the financial world itself. Capital shifting danger being recalibrated. Language from insiders that echoes earlier periods of stress. Again, not predictions, not guarantees, but indicators. And when multiple indicators begin to point in the same direction, the smartest approach isn't to panic, it's to pay attention. Because the genuine danger for most individuals isn't that they'll observe something coming and overreact. It's that they won't observe it at all until they're forced to react. So instead of treating all of this as something distant or abstract, the more practical question becomes, what can you genuinely accomplish with this information? Not in a dramatic all-or-nothing way, but in straightforward, grounded steps that bring your comprehension in line with how the framework genuinely operates today. The first step is clarity, knowing precisely how much of your money is covered under FDIC insurance and how much isn't. And that's not something you have to guess at. There's a tool for it. The FDIC's own electronic deposit insurance estimator lets you map out every account you have across institutions and observe where you stand. Because one of the most common presumptions is that coverage applies per account. But in reality, it's organized per depositor, per financial institution within specific ownership categories. And that distinction matters more than most individuals realize. The second step is distribution. If you discover that you're holding amounts above insured thresholds at a single institution, one of the simplest ways to reduce exposure is to spread those funds across multiple financial institutions or account types. It's not complex. It doesn't require predicting anything regarding the future, and it aligns your positioning with the regulations that already exist. The third step is perspective, rethinking the presumption that a traditional financial institution account is the only or inherently safest location to store all of your liquidity. There are other instruments, other organizations, each with their own trade-offs. But the key is comprehending that secure isn't a fixed label. It depends on how the framework around it is organized at any given duration. And none of this is regarding attempting to outsmart the framework or anticipate a specific event. It's regarding removing blind spots because once you comprehend how these levels fit together, you're no longer operating purely on presumption. You're making choices with visibility. And that alone alters how you interact with your money in a meaningful way. And once you begin examining at the framework through that lens where organization matters just as much as headlines, you begin to notice something else. Banking isn't the only area where quiet modifications are occurring beneath the surface. It's simply one piece of a much larger puzzle because the same kind of pressure we've been discussing about, tightening conditions, shifting regulations, increasing dependence on confidence is displaying up in other parts of the economy too. Credit markets, real estate, sovereign debt, even how liquidity moves globally. They're all connected, and when those connections begin to strain at the same duration, the effects don't stay contained in one location. That doesn't mean everything breaks. It means the framework adapts, it restructures, sometimes gradually, sometimes all at once. And the individuals who navigate those periods best aren't the ones reacting to headlines after the fact. They're the ones who comprehend the underlying mechanics early enough to adjust before it becomes obvious. That's really what this comes down to, not predicting a collapse, not presuming the worst, but recognizing that the foundation isn't static. It evolves. And right now, it's shifting in ways that most individuals haven't been demonstrated clearly because think regarding how this entire situation unfolded. A decision occurred, regulations were adjusted, a 90-day period opened, and unless you went examining for it, unless you read through regulatory filings or followed specific channels, you probably never observed it. No major coverage, no widespread clarification, no moment where someone broke it down in straightforward terms for regular individuals whose existences are directly tied to it. And that space, that distance between what's occurring and what's widely comprehended is where the biggest disconnect usually exists. So the genuine takeaway here isn't simply regarding financial institutions, it's regarding awareness. It's regarding comprehending that the frameworks you depend on don't announce every meaningful modification in a way that's easy to observe. Sometimes the most significant shifts are the quiet ones, the ones that don't interrupt your occasion, don't trigger an alert, don't force your attention, but still reshape the environment you're operating in. And right now, you're in one of those moments, a narrow period where something significant has altered, where there's still duration to comprehend it, still duration to examine at your own position, still duration to decide how you desire to respond before it simply becomes the new baseline that everyone adjusts to after the fact. You don't need to overreact. You don't need to presume the worst, but ignoring it entirely. That's the one option that leaves you completely exposed to whatever direction things move next. So take a closer examination, run the figures, comprehend where you stand. Because in a framework constructed on confidence, the individuals who ask better questions tend to make better choices. And right now, there's one question that matters more than anything else. Are you operating on what you presume is accurate or on what genuinely,